We're 21 hours from the Fed's next interest rate decision, but the options market is pricing in a less than 1% move in the S&P 500. That's smaller than average. So is the Fed pause pretty much fully priced in? Well, joining us now, Wu Silverman, RBC Capital Markets Head of Derivatives Strategy. Amy, is it?
Pretty much, yeah. Look, in post-debt ceiling, we've really had this crash in volatility and as well as this decline in demand for hedges to the downside. I'd say if I had to tag where the options market sentiment right now, it's much more about the fear of missing out on the upside than it is concerned at all about downside heading into tomorrow.
Okay, so I'm looking at your notes here, and you talk about the fact that with low levels of option prices, there are two opportunities that are attractive right now. What are they?
Yeah, I think of this two ways. Whenever you get this kind of down crash in option price levels, if you are worried, if you think, there's any chance that Powell maybe doesn't say anything about a rate hike tomorrow, but may indicate some more hawkishness, then, you're getting a bargain in terms of downside hedges right now. Now, on the flip side, if you've been missing out, then the options market can help you leverage into positions to get to that momentum on the right tail a little quicker. We see that through using calls for stock replacement, for instance, or using call spreads as a way to leverage upside more quickly.
What's going to cause volatility, if anything, whether there are pauses or rate increases in the future? I mean, we saw in short-term rates such volatility earlier. Should we think that's gone?
Yeah, it's an interesting question. Look, one thing is just data, and the options market, similar to the Fed, is quite data dependent. And I will tell you, seasonally, when you look at VIX levels, seasonally VIX just tends to be higher in August. So we've got this interesting point where I think a lot of this is relief because the debt ceiling just kind of came quicker and easier than people anticipated. And so a lot of these hedges folks did have on, unfortunately, that premium burned away. They're not really willing to reinitiate after just being burned, but that doesn't mean that data in the future couldn't be a catalyst for options. And that's usually what causes volatility to pick up.
But what's left? I mean, we had debt ceiling. We wrung our hands about that for a while. That's gone. Where's the Fed going to go? We were wringing our hands about that for a while, but it seems like, okay, we probably get a pause now after the CPI print and maybe some gradual increases in the future, but that seems unlikely to cause volatility. What are your big questions left for 23?
Obviously where the path of inflation is. But, the one thing I'll tell you, because I remember the weather in New York City on Wednesday when the sky was blood red, and the point just being, you never know where your left or right tail is going to come from. That could be geopolitical. It could be something that's just simply an unknown. I think those are interesting. But in terms of what is left, I think just each data point that comes out, if it surprises, I don't think that's baked in right now. Right now, we're baking in an options market, which sort of says slow and steady is the course. And, as we have seen in the past, that's not always necessarily true.